Good afternoon, everyone. This is Stuart. We have a number of administrative and market updates to start the week, so let's jump in. To start, we've moved offices. We're still in the same building, but have a new and improved office suite, replete with better views, a much improved meeting space, and an interactive putting green. So come stop by to see us at Suite 325 at the Port Clinton building in Highland Park, located still at 600 Central Avenue. And for clients who are in the area, we're hosting a new office party this Wednesday, December 10th from 2 to 5 p.m. Let us know if you can make it. We hope to see you. On to the markets. The Federal Reserve has its last meeting of the year later this week, where expectations are for its Open Market Committee to announce the third and final rate cut of the year, bringing the overnight policy rate from an upper bound of 4% to 3.75%. Investors in the Fed itself expect the policy rate to drop to 3% over the next 2 years. We'll need to see if the Trump administration's appointment of a new Fed chairman next year will have a meaningful impact on the trajectory of interest rate policy. We think the Fed will have a difficult time cutting materially more than consensus expectations unless the economy slows, as inflationary pressures have proven frustratingly stubborn the last few years. Regardless what the Fed does, the real action is in 10-year U.S. Treasuries, where yields have found a new floor of 4%. The risk for Treasuries is that economic growth remains strong and the Fed continues to cut its policy rate with inflation hovering around 3%. In such a scenario, we'd expect long-term rates to continue rising as investors demand compensation for persistent inflation and fiscal risks. So far, stocks have held up fine as rates have repriced higher from the 2% range in the 2010s. So long as economic growth and corporate profits are robust, 4 to 5% interest rates don't appear to be a headwind. However, any sharp repricing higher would likely result in pressures on equities. We think the greater risk is on the consumer side, where elevated rates make everything from buying a home to taking out a car loan much costlier than several years ago. Surveying the stock market, one pocket that has materially underperformed the last few years is application software stocks. Think companies such as Adobe and Salesforce, despite many of these firms having mature defensible businesses with healthy sales and profit growth. The culprit for underperformance? Fears about artificial intelligence disrupting their business models by enabling users to easily code up their own versions of enterprise software applications. As heavy users of AI, we understand these concerns. AI continues to improve at a rapid pace and will allow users to build many of their own features. However, we think we're a far way away from users developing their own mission-critical, zero-margin-for-error software that can scale to millions of users. That's not to say it's an impossibility, but markets have repriced some software firms as if that is an all but certain outcome. With valuations at non-demanding levels that are pricing in revenue and sales destruction, we think several of these stocks have been largely de-risked and are worthy of consideration. Finally, we've started to dig deeper into the robotics industry, which we think will capture a growing portion of investor mindshare in the coming years. In short, the confluence of improvements in hardware, software, and artificial intelligence, plus increased business interest and federal policy support, have all aligned to make this an exciting area to track. Companies across the robotics value chain, from software and components to finished device makers, might all stand to benefit as robots move from narrow roles in warehouses and factories to broader roles in the real world. We recommend watching some of the product demos, such as the Figure 03, pictured on the cover of Time magazine. We're approaching an inflection point where ideas from science fiction cross over into reality. If you're interested in the theme, we're working on a brief industry primer that we'd be happy to share soon. And if you have any questions about today's discussion or your portfolio or the markets generally, please feel free to reach out. Thank you and have a great start to your week.